In 2025, if you are a global investor, your portfolio has likely been dominated by one story, artificial intelligence. We've seen staggering rallies. AMD surged 235% in 2025. Oracle is up over 130% since April. And AMD's is over 63. The question is no longer is AI real, but is this valuation sustainable? And the skepticism is growing. In October 2025, a Bank of America survey found that 54% of institutional investors believe AI stocks are in a bubble. Famed investor Michael Burry, known for The Big Short, has reportedly taken a massive $1.1 billion short position against the AI leaders. He is drawing parallels to the dot-com crash, pointing to the massive spike in capital expenditures as a warning sign. This is what I call capital-oriented growing, where massive capital, hype, and speculation drive valuations. But here's the deeper issue: what some analysts call circular fantasy. Big tech invest billions in AI startups like OpenAI, which has committed over $1.4 trillion in spending. Those startups then immediately use that money to buy GPUs and cloud services, often from the same big tech investors. This creates an echo chamber of revenue growth. It's capital driven, but when if there's another way, a policy oriented growth? As someone who lived and worked in China, I see a very different story unfolding. One that is not driven by capital hype and by a long term, deliberate national strategy, a policy oriented focus on the real economy. Today, I will provide the ultimate guide for global investors on why and how to look at China. So to understand China, you must understand its state like the industrial policy. This isn't just a slogan, it's a structural pivot away from being the world's factory. Policies like new quality productive forces are a direct response to structural challenges like a serious labor shortage and an aging population. They are planned to dominate the high-tech, high-value industries like AI, biotechnology, and advanced manufacturing. This is conflated in the upcoming fifth five-year plan, which prioritizes industrial modernization and sci-tech self-reliance above all this. But does this top-down policy model work? Let's look at the new energy vehicle or NEV market, driven by policies like Made in China 2025 and significant government support. China's NEV retail sales soared. In the first 9 months of 2025, they accounted for over 50% of the total vehicle sales. This is a goal China reached 10 years ahead of schedule. This is the proven playbook now being applied to AI, aerospace, and biotech. This policy is fueled by a massive investment in innovation. While the US still spends a higher percentage of its GDP on R&D at 3.45% versus China's 2.68% in 2024. That's not the full story. China's R&D spend grows at 8.9% in nearly double the US rate 4.7%. And in real terms, adjusting for purchasing power partly that called the PPP, China's R&D expenditure is already at 96% of the US level. Even more telling, one report notes that 100,000 in China can support 2.3 R&D workers versus just one in the US. In terms of real research output, China, may already be ahead. This innovation supports a stable macro environment. The IMF forecasts China's GDP growth at 4.8% for 2025, and the World Bank forecasts 4.5%. This is powered by the world's most dynamic consumer market. While you may hear stories of a cautious consumer, the data shows resilience. In the first half of 2025, domestic and international air travel surpassed the 2019 levels. By 2030, 6% of urban consumption is projected to be driven by the upper middle class, a dominant global force. But for me, this is the most important slide. Policy and growth are one thing, but what about risk? Morningstar data shows that correlation correlation coefficient between the Chinese equity market and the US market index is just 0.12. This is incredibly low. It means when the US market falls, Chinese stocks don't necessarily follow. For a portfolio overexposed to the US AI bond, China isn't just a growth play, it's a powerful diversification tool. So, you are convinced of the why. Now, for the now, investing in China as a global investor can seem complex. You heard of A-shares, H-shares, ADRs. I will demystify them for you right now. The simplest way is an exchange traded fund or ETF. You can buy this from your regular broker. They are funds that track an index, allowing you to buy the entire Chinese market or a specific sector in one go. They offer great diversification and a low barrier to entry. The main drawback is you don't pick the stocks and you must check what the ETF holds. Next is the ADRs, or American Depository Receipts. They are certificates for shares of foreign companies that trade on US exchange like the NYSE or Nasdaq, priced in US dollars. They are easy to buy, but you must understand the risk. You are exposed to US China regulatory and political tensions. You are not just investing in the company, you are investing in the fragile relationship between two superpowers. A more direct professional route is buying H shares. These are Chinese companies like directly on the Hong Kong Stock Exchange. This is the preferred route for most global funds. It's a heavy liquid, internationally regular market priced in Hong Kong dollars, which is pegged to the US dollar. This avoids the direct US China political risk of ADRs and has the same massive liquid inflows. Finally, the pro level E shares. These are the companies listed on the mainland in Shanghai and Shenzhen, traded in RMB. This is the real domestic economy. This is the market that has that low 0.12 correlation. Historically closed, this market is now accessible to all global investors through a program called Stock Connect. This gives you access to nearly 2,700 mainland stocks and is the avenue for true diversification. This all sounds great, but how do you actually buy them? It's much simpler than you think. It's a three-step process. First, check your current broker. Many large US or European brokers like Schwab or Fidelity already offer access to international markets, including Hong Kong for H-shares and, of course, ADRs. However, if you want direct A-share access via Stock Connect, which I recommend for diversification, you will need a specialist global broker. A well-known example is the US and Europe is interactive brokers, which is one of the few that offers this direct access to non-residents. Finally, before you invest, understand the machines. You will have currency risks. Your invest will be in RMB or HKD, and its value in your home country will fluctuate. You will also have to pay currency conversion fees, and you are subject to local market regulations. This is standard for all international investing, and any good global broker will guide you through the necessary tax forms like the W8BEN form. So let's summarize. White global capital is distracted by the AI help. China is excluding a deliberate, policy-driven industrial upgrade focus on the real economy. For you, this presents two opportunities. First, a long growth story, and second, a powerful diversification tool with a 0.12 correlation to make your portfolio more resilient. You can start simply with an ETF or get direct access where it shares or stock connect. Okay, so at last, I must tell you that this is the kind of deep data-driven analysis we will be providing every week. If you want to understand the global markets from a clear, objective perspective, subscribe to the channel and like this video. And please comment below with what you want me to analyze next. As always, this is for education, not financial advice. Please do your own research.